Joining me for more is Kyle Rodder from Capital.com. Great to see you, Kyle. So, look, overnight, US markets quite choppy. I just saw a photo of a guy in the trading room floor with his hands on his head, basically. Tell me what happened.
Well, it looks like we're seeing a bit of deflation in the fairly rich valuations of a lot of US tech stocks, and there's a couple of reasons why this might be the case. I mean, on the surface level, we're seeing some signs of nervousness amongst US consumers, and we saw that in another US consumer confidence reading last night. Last week saw some data suggesting that some of the uncertainty brought about by the Trump administration's policy platform, especially tariffs, is causing concerns both about growth going forward and inflation. And then also some fairly interesting and maybe technical dynamics going on under the surface, because this is obviously primarily driven by, again, this deflation in tech stocks, or deflation in the valuations of tech stocks. And there's been a couple of stories there over the last couple of days that might be responsible for that too. One, reports from Microsoft that it's going to be reducing investment in its data centers, sort of suggesting, again, some of these concerns about overcapacity in the AI spend or excess investment in AI spend. We've also got Nvidia earnings coming up on Thursday, which could potentially be a risk event for the broader sector. Tell us a little bit more about chip demand and the outlook for AI development more broadly. And at the same time, we're also seeing actually a bit of a reflation in Chinese tech stocks. So possibly we're seeing some money coming out of the expensive US tech stocks, moving into the Hang Seng, for example, stocks like Alibaba, which are looking like they're making headways in the artificial intelligence space too. So maybe a bit of a rotation there, or a movement of flow from the US to China, or more specifically the Hong Kong market. So a few fascinating dynamics, but clearly, at least when you look at the Nasdaq, down quite significantly over the last few days. And market sentiment seems to be, relatively bearish compared to what we've seen over the last 3 or 4 months.
And some weak consumer confidence data coming out of the US. So how important was that for investors to really deliberate?
Yeah, it was rather important, and it sort of adds to a slew of consumer confidence reads, which sort of suggests that, again, households are becoming a little bit nervous, mostly by virtue of the Trump administration's policy platform, primarily due to trade. But there's also these concerns about Doge and what that will mean for a lot of people's livelihoods, and also government spending effectively going forward as well, and how that might hit hip pockets as well as aggregate demand in the US economy. There's also these persistent fears of this kind of stagflationary light dynamic emerging again, where there's upward pressure on inflation coming through because of some of these policy measures. At the same time, growth is weakening, either just because of a lack of confidence or because of the impact tariffs might have on economic activity, as well as on top of that too, again, the spending cuts coming from Doge, what that will have on impact will have on economic activity. So we've got this PCE data at the end of the week. It's going to be very crucial to get a gauge for the price pressures in the US economy and what prospect the Fed has to lower interest rates in the event, for example, that growth starts to weaken. And it now seems that, this kind of momentum in equities is fading. The US dollar is dropping, suggesting that the US economic exceptionalism story is starting to wane as well. And treasury yields are dropping too. So there's that sort of search for liquidity and safety. So all those sort of hallmark signs of a market that's getting a little bit nervous. And again, a lot of it I think can be traced back to kind of the uncertainty delivered by the Trump administration and its policy platform.
And US Treasury Secretary Scott Bessent, speaking in Washington at that super conference today, he has made some comments regarding tariffs and potential impacts on Australia. So what's the latest?
Well, I suppose he's going to really emphasize this kind of 3-3-3 dynamic, which is, talking about, boosting energy supply, talking about getting the US deficit down to 3% and maintaining 3% growth. If you listen to most economists, they think that's a very ambitious target, but, politicians have to set ambitious goals, set out a vision for the future. So, far be it from anyone, or certainly myself, to suggest that that's not a viable goal. But nevertheless, I mean, there is the economic platform that the Trump administration is trying to operate on, or trying to communicate, and then there's also the practicalities around how is the Treasury going to potentially enforce or I suppose, respond to the impacts of different fiscal policy measures coupled with increased tariffs and how the tax mix might change in the United States, or at least what the Treasury Secretary's vision is for that. There's also these kind of highly political, and I dare say from listening to Scott Bessent speak recently, especially on Bloomberg, he gets a little bit nervous when questions about this come up. But, some of the economic sanctions or economic measures related to the Ukraine-Russia war, especially this deal to acquire rare earth minerals from Ukraine in exchange for effectively a peace deal, and as far as the Trump administration is concerned, payback for the money that it has put into the war effort in Ukraine, what that policy is actually going to look like, how the politics of that is going to play out, considering the very complex environment that the Trump administration has created with its change in foreign policy positions towards European security and Russia diplomacy with Russia. A few days ago in the meeting between Trump and Macron, Scott Bessent said that they were effectively yards away from being able to strike a deal with Ukraine about minerals. So we'll be looking for that final details relating to that too. But again, at a high level, it's about this kind of 3-3-3 policy. And then on top of that, how the Treasury Secretary navigates the complex foreign policy and trade policy environment, which is clearly shaking up the world economy, but also the US economy.
And coming back home now, in Australia today, we'll have a monthly CPI figure. So how important will that be for the RBA?
It will be significant. I mean, I think that the RBA won't look to move rates until it sees the official CPI data out of for the March quarter, which will be released in April. So the next meeting, I think, live meeting is probably going to be May. But these inflation reads are going to be important because we're going to get an impression on the trajectory from here. And I think that effectively what we need to see over the next few months is that inflation is starting to trend. Trim mean inflation is trending to 3% or below for the RBA to feel comfortable enough to cut interest rates again at that particular meeting. So you tend not to get the trim mean forecasts widely distributed going into the monthly CPI indicator. We do know that the forecast for the headline number is expected to rise to 2.6%, but obviously everyone's ignoring that because that's been massaged lower by the government's energy subsidies and remains clearly not what the RBA is focused on in terms of setting interest rates. But again, we're looking at that trim mean figure. If it looks like it's trending towards that lower than 3% area, which would suggest that we're getting close to or within the RBA's 2 to 3% target band by the end of this quarter, then that's going to renew that confidence that the RBA will be able to cut interest rates again. Of course, if it comes in a bit higher than that, that cautious stance that the RBA adopted last week starts to get vindicated a little bit, and those sort of two-way risks to policy in the markets are, a little bit greater than what they would be otherwise. So fairly significant. Again, it's all about CPI. That official CPI at April for the March quarter, but these indicators will tell us the sort of direction of travel and what confidence we can have that the RBA might be in the position to cut interest rates again, at least, if not at the next meeting, then certainly in May.